let's go ahead and get started. I want to go ahead and I want to go through, and I keep a journal. That's the one thing I will say as a trader, for those of you that are in the marketplace, get yourself a journal. Learn how to go ahead and mark down not only the trades that you're in, but the ones that you're looking at. So I've done that. I have a whole list of things outlined for you guys that I'm going to take you through. And I believe that the way people learn the best is by not talking about what happened in the past, but being able to talk about what's going on right now in today's market and how do you prepare for Monday. And I always say that. Those of you that follow me on Instagram, you know that I always say it's all about preparation. When the market opens up, that's execution time. So preparation is everything. So there's certain trades that you'll get into. I'm going to talk today a lot about options, but I know that I'm known on Clubhouse for producing like 5X trades, 10X trades. We all saw that with the BNGO and SNDL and many others that we've talked about and that actually came to fruition. They don't always come to fruition, but a lot of them do. Enough of them do. So I'm going to talk a little bit about some of those trades that I'm taking a look at right now. And I'm going to share my screen with you. Actually, I'm going to share my chart with you. So let me do that. Let me share my chart and bring this up. Gene, can you see the chart?
Yes, sir. Looks good.
Very good. So this is, and I'm going to see, can I make this bigger? Is it big enough, Gene?
It's plenty big on my screen. I'm on an iPad.
Okay, very, very good. So one of the first stocks that I'm going to talk about, and I'm going to talk more than, I'm going to use the stocks, guys, that I am looking at going into the upcoming week. I'm going to take those stocks and I'm going to talk about, there's some of them that I'll have time to talk about why I'm getting into those trades. But I think really important for today's session, I want to utilize this time to be able to say, if you're interested, so it's not even just about the stock that I'm looking at, but I'm going to use those stocks that I'm looking at to show you how do you design and architect those trades. So the first one that I'm going to bring up is CRBP. So this is Corpus Pharmaceuticals. You've heard me talk about this before, and I'm going to move my face out of the way so I can see. Here we go. So you've heard me talk about this before. Give me one quick second. Let's put this to the side. Okay, so on Corpus Pharmaceuticals, there's a couple reasons I'm interested in this. Many of you that follow me know that I like being able to trade a catalyst. So I'll look at fundamentals, I'll look at technicals, but I love a good, strong catalyst, because that is what sends a stock in any given direction, whether you're shorting the stock going down or whether you're trading it to the upside and it's moving up. So Corpus Pharmaceuticals, and there's never a guarantee, guys. So I don't want you to take this as advice, because I'm a hedge fund manager. I'm a licensed financial advisor. This is not advice. This is education only. So I'll tell you what I'm looking at and the lens I'm looking at. You make your own decisions. Do your own DD, your due diligence. So when I'm taking a look at Corpus Pharmaceuticals, it's a weed play. It's a weed play that has different. They're taking weed and they're applying it to different medical applications. They're taking a look at being able to solve a whole variety of different diseases out there. One of them being like lupus, inflammatory diseases, mixed connective tissue diseases, all which I'm very familiar with. Corpus Pharmaceutical is in that space. And they have, the thing I like about them is they have a good solid pipeline. If you go back and you look at your due diligence, a big solid pipeline of different trials that are going on right now. One of them just came out. They have another one that's coming out sometime this quarter, the results of the quarter for Q2. And I think, and the word on the street is it's looking pretty good. If they come out with what I think they're going to come out with, and they're going to present it before the FDA, and it's a great report, a great study, it'll send this stock upwards to what price targets. We always have to talk about a price target, right? Can't just say, hey, I'm going to shoot for the moon, although that sounds cool. But what I'm looking at is about the $8.50, $9 area, and I'll tell you why. So if we take a look at this, and I pull up a one-year chart, you can see back here at this area, back in September of 2020, there was a big gap to the downside. So companies that have gaps to the downside, if they're good, solid companies, which I believe Corpus Pharmaceutical is, and then if there's a catalyst that goes along with it, there's over a 90% chance that those gaps get filled. So this gap would get filled at around just a hair under $9 a share. That would be amazing. So when I take a look at this, people say, well, how do you jump into the trade? I typically scale into trades. So when I'm looking at the trades, if we can take a look at this, this is what I like about this. I look at multiple time frame analysis, but you can see it's been in a downtrend. So a lot of people say, oh, I want to stay away from that. So those of you that do like real estate investing, like I do, you're gonna relate to this. What are the homes that you typically buy that give you the biggest profits? They're the ugliest homes. They're the homes that are ugly that nobody wants. Fire damage, mold damage, everything else. Nobody wants them. But the key is, if you are trained and you're educated in this space, then you take a look at it a little bit differently and you say, whoa, this is money. So when I take a look at this, I understand about the nature of gaps getting filled with a 90% probability on good, solid companies. And I take a look at this, you see this trend to the downside. And then all of a sudden it starts to baseline. You see this baseline? This is where I start to scale into the trade. So I've been buying. So I have a certain number of allocation for what I'm going to do for each trade. I already know that. It's not a guessing game. It's not, gosh, I wonder how much I'm going to put on this particular trade today. Let me go all in. That's a rookie's mistake. I take a look and I say, here's the allocation that I have, and I'm going to start to scale in. I may scale in chunks of thirds, 1/3, 2/3, 3/3. I may, if I'm uncertain about it, and I think it's going to be a little bit longer base, like it was with this one, I may go in like eighths. I did this one in eighths. I did 1/8, 2/8, 3/8, 4/8, scaling into it. So doing a dollar cost averaging, but with a purpose. So I also have a line in the sand of, hey, if it breaks my line in the sand, I'm going to get out of the trade. So it's always important to understand you have a backstop, right? So you know where the backstop is going to be, and you're scaling into that trade. You're buying over time. And those are the things that work out for me and have led to my success in the marketplace. But if you look at this, so it's been in this downtrend, and now it starts to get a little bit of pop here. So this is where one of their trials has just started. So they're doing multiple trials. One of their trials just started. So news came out, then they got a patent, and we start to see this thing break to the upside. I don't think it's going to be much longer. I don't know when, but it's supposed to happen in Q2 that the report is going to come out. And again, if that report is solid, this thing goes up. So this is how I'm looking for these 5x returns, these 10x returns. It's the same thing I did with SNDL, having a catalyst behind that, or BNGO in the genomics play, having a catalyst behind that. This is what I look for. I like these type of trades. Although I will say I would say the bulk of my trading style is hedging. And you'll see that as I get into this, I typically like to hedge. But I also like these type of trades because these make me money, massive amount of money. I'm talking, I've done trades where it's been, not only a 10x, but a 20x and a 30x. So they're out there. And as my friend Joe talks about, he goes, there's trades out there that have 100x return, and they're out there. On those trades, you just have to be a little bit more patient. And this is a trade that I just recently got into. It's called WWII. Joe knows about this because I announced it. I think, Joe, you're in it as well. I got into this I scaled into it about 15 cents. 15 cents. This is a penny stock, 15 cents. People say, hey, Bruce, so you like penny stocks? Folks, I like anything that makes money. That's what it comes down to. So the penny stocks, though, I don't shy away from them. If they are, this is not an OTC stock. This is one that trades on the NASDAQ. If it's a stock that has good legs and good opportunity, and I'm willing to go ahead and say, let me hold this particular trade a little bit longer, then I'm gonna go ahead and do that. So I'll put risk capital on there for the potential to put down, let's just say $1,000, and this turns into $50,000. Is it possible? It's very possible. So when I take a look at this trade, my price target really for me, I think is about $6 a share. And you may think $6 a share, this thing's trading at 15, 20 cents. That's what I'm talking about. These are opportunities. This is a 5G play. Again, those that make massive amounts of money in the marketplace, we have a tendency to look around the corner. And this is what other people are not looking at. So a lot of the trades that I've announced on Clubhouse that I've looked at, people have never heard of those trades. They say, well, I've never heard of that. But they're not all penny stocks, but a lot of them are for those directional, massive type of trades. And that's the commitment I made to myself, was I want to take a look at what's around the corner. I want to look at industries that are out there, like 5G, which I think is just getting started. It really is. It's just getting started. It amazes me really when I think about it, because back in 1993, I remember I got my first phone. It wasn't this though. It was the GTE mobile net phone. And it was probably about as big as it was actually a briefcase with a cord on it. And I remember I even hesitated to use that call except for clients because it was so freaking expensive. and I tell you that this happens just in my lifetime. Think about that for a minute. Think about, I didn't start using a computer until 1990. And I had my Apple Mactop, and I had that thing. I was carrying a carry-on, and it wasn't the thing that I have today. It was like about this big, that wide, this deep, and that was a carry-on. I take a look at where technology has gone right now. It's just amazing. But think about that. If you would have had knowledge about Apple and some of these microchips that have been going on that supply the juice for a lot of the computer that we use, would you have entered into those trades early on? You betcha you would have. You betcha you would have. So this is what I like to do. I don't take all my portfolio and put it into stocks like this because it is speculative. It's a speculative type of trade, but at the same time, the reward to risk is freaking off the charts. You don't get that anywhere else. So I look for trades like this. Another one that I'll do before I get into options. So a lot of people talk about EV, the EV play. Well, think about that for a minute. Do you want to go ahead and bet on Tesla or NIO or some of the other ones that are out there, or Ford? Or do you want to go ahead and kind of be the person that you're betting on the racetrack, where you can go ahead and feed all these EV plays? So that's still at the top of my list. So this is one that I have for me. I have it in my children's account. This is BMIX. It's a lithium play, and I think lithium plays are going to go up huge. So this is another one that I just go ahead and I set it and I basically forget it. It's one of those trades that I'm looking at, that maybe in 5-10 years, maybe sooner, but who knows? I don't count on it. But these are the type of things that I like to be able to do to give my portfolio some juice. That's what I want. I want the juice. So this helps me get there. But again, this is a smaller portion of my portfolio when I get into these type of trades. A lot of the ones that you guys are used to, and there's still some trades out there that few people have heard about. You heard me talk about this before, this particular stock. It didn't work out in the beginning like I wanted it to do, but I had put options, and we'll talk about those today. I had put options for my protection for leverage. Now I'm looking at this and saying, I want to jump back into this particular trade. Matter of fact, I already have, and I'll tell you what I did. So this is where we get into the options. So buckle up the seat, because this is going to blow your freaking minds. I'll tell you that right now. Here's the thing that I want to share with you. A lot of people, let me stop share here for a minute, because I want to share something else with you before we go further. When you take a look, let me just make sure nobody else is waiting. Okay, nobody else is waiting. When you take a look at most of the mindset, and you ask yourself this: when people talk about call options, those of you that know about options, when people talk about call options, what do you think about? Where's your mind go in terms of directions? Are you bullish on a call, or are you bearish on a call? Most people are bullish. They think call options, bullish, put options, bearish. And that's not exactly correct. That's not the entire equation. So when you take a look at this is what I want to share with you. When you take a look, can I share this? Let's see here. Give one quick second. Yeah, here we go. Let's take a look. So when you take a look at this, you're going to want to write this down, because those of you that were thinking, well, calls are bullish and puts are bearish, it depends. It depends on what? It depends. Are you buying or are you selling? When you're buying a call, you're bullish. You're anticipating the stock going up. When you are bearish on a stock and you're trying to profit from the downturn, you're looking at a put option, buying a put option, and you're looking at the stock going down. However, and this is one that Warren Buffett does that very few people even talk about. Warren Buffett has a habit. More people are coming in. Warren Buffett has a habit of selling puts. Doesn't talk about it. And I'll tell you why he does that. Because when you go out there and you have the type of capital that he does, you're going to move the dial of that stock. You're going to move the dial where he's not going to get in at the price point that he wants. But by selling puts, he does. Because, and we'll talk more about this as you start to take a look at as we start to go deeper into my examples. But this is the framework that you have to be able to understand what I'm talking about on these next couple examples that I'm going to give you. But when you're selling a put, in my opinion, it is better than buying the stock in many ways. And we'll talk about those things. So selling a put is bullish. Where you're selling a call, you have more of a bearish bias on it. So that's one thing that I want to share. Here's one more before I move on to some of these things. When you take a look, the way we were raised, I don't care how old or young you are, most people will tell you when they talk about the markets, they're going to say, what's the secret to investing in the marketplace? And they're going to tell you, well, the secret is you've got to learn to be able to do what? To buy low and what? Sell high. But here's the thing they don't teach you in school. And I'm very well educated. I have 2 undergraduate degrees and an MBA in international business and finance. They did not teach me about this. When you take a look at buy low and sell high, that's correct. But what they didn't teach you is that you don't have to do it in this order. You could actually sell high first. And Joe, you know all about this all too well because Joe's been short in the market lately. But you sell high and you're looking to buy it back at a lower price. So it doesn't change buy low and sell high. You're just doing it in a different order. You don't have to start with buy low and sell high. You can start with sell high and buy low. They didn't teach you that in school, did they? So these are the things that you can do, but it's important to understand that. And you may think, well, how do you do that? Don't worry about that right now. Just understand the market allows you to do that. That's called shorting a stock. So let me go back to my Thinkorswim platform. And now that we have that out of the way, so here's Clover. Now, as a stock investor, let's say you take a look, and again, you do your own due diligence. This is also going to serve as a couple things, guys, and this is what I do on a regular basis, is that this serves as a think tank. I'm not telling you go out there and buy Clover. I'm telling you I'm in it. But what I would expect that you would do, if you're a good student of the marketplace, is to do what? To write these things down, because I've already done my due diligence, but for you to do your own due diligence and see what you like or what you don't like about it. Maybe you think I'm out of my mind by choosing a company like this. We'll see. Maybe I am out of my mind. But these are things you want to do. You want to write down the stock symbols and you want to do your own due diligence and see if it's right for you. I think it's right for me, but you got to make that decision. So if you are a stock investor and you say, man, I agree with Bruce. I like Clover Health for all the things that I think the stock has been shorted unnecessarily. I really do. I think there's a battle going on there, a political battle. I think this stock is coming back now. So there's a lot of things I like about it. But let's just say you've done your due diligence and you take a look at this and you say, man, oh man, I like Clover Health. It's trading for $8.77. What can I actually do with it? So what I did with it, so I got it at $8.54. So I'm not too far ahead of you. I got it at $8.54. What I did was I sold the May $9 calls on it. I took in a credit of $1.25. So that gives me it breaks my break even down to $7.29. If it trades above $99 a share by the third Friday of May, which is in like less than 28 days, I'm going to walk away with a 20% return. If it just stays above 9, I'm locked in at 20% return on those numbers. My break even is at 729. So this is what I call a non-directional trade. So I'm going to break this down for you in this example. If I wasn't in the trade and I was looking at it, so write this down so you start to understand this. This is how you're going to learn. So when we take a look at this, we're looking at $8.77. So let's say you went ahead and you bought it at $8.77. What you could do is come over here and let's say you sell right here. These are the options. So for those of you that are new, this is an option chain, right? These are calls on this side. These are puts on this side. This right down here in the middle is what we call a strike price. This is a strike price. So if I choose the $9, I can choose whatever I want to. But let's say I choose the $9 call option, but I'm not going to buy it because I'm buying the stock for $8.77. You follow what I'm saying? So write that down. Buy to open the stock at $8.77. At the same time, what I'm going to do is once that order gets filled, I'm going to sell the $9 call option, which expires in when? The third Friday of May, right? So what I'm doing when I'm selling is I'm not paying 90 cents. I'm taking in a credit of 90 cents. So I'm taking in a credit of 90 cents on this particular trade, which reduces my cost basis on the trade. When I sell it, now let's say that stock goes up though. The stock moves up, I bought it for $8.77 and the stock moves up and goes past $9 a share, which is really what you want. You want it to trade at 9 or higher in the near term if you wanted to cash out on this thing. So that means you're not selling it for 9 because when you're selling a call option, you're obligated to sell the stock at that strike price. So here you're obligated to sell it at $9, but wait a minute. You're not selling it at 9, you're selling it at 9 plus the 90 cents that you took in. You're really selling it at $9.90. Well, if you bought it at if you're selling it at $9.90 and you bought it at $8.77, your percentage return in less than 27 days is 13%. That's kind of cool.
Amazing.
Now think about this though. Think about this. Because you got to understand like the rule of 72. I don't know how many of you, know numbers and whatnot, but the rule of 72 tells you what? It tells you how quickly is your account going to double based on a couple of factors, based on the frequency. So we're here we're using 27 days. Let's call it a month based on the frequency and based on the percentage. So if you take 72 and you divide that by 13%, your account is doubling in less than 6 months. At 12%, it's every 6 months your account doubles. This is important stuff, and people don't talk about this. They're always looking for the big home runs, and that's why I say those are smaller portions of my portfolio, because I understand things like the rule of 72. If I can go ahead and get 12% and double my account every 6 months across the account, I'm golden. And if I can set it up with a non-directional trade, like what we're talking about here. So if you don't understand this, don't worry about it. Just understand that this is what you can do with it. It's not only key that if this trade moves over $9 a share, and we're at 877 right now, if it moves over $9 a share, you're locked in at 20%. Now you're capped there, or 20%, 13%, you're capped there. So that's the disadvantage though, right? You're capped. So if the stock took off and ran like a scolded dog and just moved up, you are capped at that 13% in this particular situation. But I don't care because I understand about the rule of 72. What it does give me though is that on the downside, my break even by taking in this, I'm buying it at 877. I took in a 90-cent credit. My break even happens to be $7.87. $7 right here and 87 cents. My break even's there. I don't start losing. So if it closes below 9, so we said if it goes at 9 or higher, you're making 13%. If it closes below 9, anywhere between my break even, which is $7.87 to $9, I'm still making money. It just so happens is if it goes from $9 or $8.90 or $8.70 or $8.50, the closer it gets to my break even, the less money I'm making. But I'm still making money all the way down to my break even at $7.87. So unlike going out there and buying the stock or doing a directional call trade, you are doing a non-directional trade. You are set up with a high probability on a stock that you like that gives you the ability to not even worry about what direction is the market going. Who cares? I have it hedged. And if you were like, you know what? That's cool, but I'm even more conservative than this. Well, no one said I said you can choose any strike price you want, as long as the numbers work out. You don't have to choose this $9 strike price. Check this out. What happens if you chose the $7.50 strike price? Think about that for a minute. You may be thinking, Bruce, are you crazy? Have you lost it? You're buying the stock for $8.77 and you're going to sell it. You're going to give somebody else the right to buy it for $7.50. Why would you do that? It doesn't make sense. The stock's at $8.77 and you're given the right to buy it for $7.50. Because of the credit, my friends, you're taking in a credit of $1.60. You're taking in a credit of $1.60 on this particular trade. It brings your break even down to $7.17. And the return on it, because what you're doing is you're taking $7.50 plus the $1.60. So you're not selling at $7.50. You're selling it for $9.10. Do the math. 910 divided by 877, you're making a 3.8% return. 3.8% return on a non-directional trade that gives you the ability. And where are you going to make that? If the stock went from 877 down to 750, you're still making your 3.8% return. So you don't even need the trade to do anything. It goes up 3.8. It stays flat 3.8. It goes down to your break to 750, 3.8. And your break even set at 717. A non-directional trade. You look, your break even's way down here.
Love it.
This is what I'm talking about, guys. Your ability to be able to, this is the stuff they don't teach you. Your ability to be able to go ahead and take a look and say, and this is the thing about it. Those of you that were from Clubhouse, you had guys that were on the call. JT Fox was one of them. A couple other guys. There was me against like eight different real estate guys. And they were saying, what's better, real estate investing? And Grant Cardone was on there as well. Real estate investing or the stock market. And Grant said to me, he goes, I don't invest in the stock market because I don't like drama with my money. That only tells me Grant may be good at doing his real estate investments, that just tells me he doesn't know anything about the stock market. Certainly, he's a well-educated guy, right? When it comes to investing. But when it comes down to the markets, it's not his backyard. So this is where you have to make the decision. If you don't like drama in your money, then learn how to hedge. Why be a directional trader, whether you're trading stocks or options, and being able to flip a coin and say what directions it's going to go? Set it up where you can go ahead and say stocks at 877. All I needed to do is stay above 750, and I'm making my 3.8% return. And my break even is at 717. That's what we're talking about. Trading in the marketplace on a consistent level. Very few people do this. Very few people know about it. This is what we're talking about. Let's move on to the next one. So when we take a look at some other things here. You've heard me talk on Clubhouse before. Joe knows I talk about this. Is one of my favorite stocks. Again, do your own due diligence. Is Kopin, K-O-P-N. Now I've been in and out of this trade because why? I'm a trader. So I don't just go ahead and buy and hold, even though, move this down. I let someone in that messed me up. Here we go, right here. So I don't go ahead and even though I have a long-term view about the marketplace, I don't go ahead and just say, well, I'm gonna just buy and hold and whatever happens, happens. That's not me. So even with Kopin, many of you have asked me before, and I said before on Clubhouse, I have a long-term perspective on this trade. But I'm not going to sit there and let the market dance with my money. I won't let that happen. So when I take a look at this trade, even though for all the reasons that I've talked about on Clubhouse, and those of you that know me, I like this trade. I've been trading it. So I do things like a hedge. So right now, let's take a look and say, how would you trade this? And if you look at this thing from a technical perspective, I mean, do your own due diligence on it. On a technical perspective, this thing's been going up and down, up and down. Now look, now we're starting to break back up. We had a nice downturn movement. So this is what the other thing about our business in the world of trading. In real estate investing, it's about what? What's the key ingredient for real estate investing? Location, location, location. They always tell us that, right? In our business, it's timing. You have to get in at the right time. So when we take a look at this, we've had a nice downturn. If we pull back a little bit, look how this thing is boom, 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 almost consistently up and down, up and down, up and down. So why wouldn't I trade this, right? So when I take a look, here it's pulled back down. We got a nice little candlestick wick to the bottom. We have a move above the moving averages here. It's trading at 846. What do you do with this thing? How do you trade it? Well, let's say that depends on you. Let's say you are more of a conservative investor. You like it. And you say, man, I like this trade. I like Kopin. How do I go ahead and I get this thing where I don't have to really worry about it? I don't have to worry about the ups and the downs. You know, if you're just a directional trader and you want to trade off technicals and you think, man, it's been going up and down, up and down. It's at the bottom and it looks like it's going up, which it does. You could go ahead and trade directionally. But if you wanted to have consistency and you didn't want to have to worry about what this thing was going to do, here's what we could do. We could buy this. And again, write this stuff down. We could buy this at 846, right? Pick it up at 846. We take a look at the Mays. Again, you can choose whatever you want to choose, June, July, whatever. We're going to take a look at the Mays. And let's say that we want to go ahead and we want to be more conservative. We could sell the 750. Here we go again, Bruce. Here we go again. You're buying the stock at 846, but you're giving somebody the right to buy it from you at 750. Why would you do that? Because I'm taking in a credit of about $1.55, maybe $1.60 on this particular trade. Let's call it $1.55. So that does what? Well, that boosts up my sell price, not 750, but to $9.05. And if I'm buying it for 846, 905 divided by 846 is what? It's a 7% return. So if you're doing 6% a month, this is a month. If you're doing 6% a month and you're finding trades like this and you're doing 6% a month, you're doubling your account every year. Even if you start with a small account, that's like massive. So these are the things we're talking about. But the other thing when you're talking about selling this, so you created another non-directional trade where you're capping yourself at 7%, but the stock doesn't have to do anything. It can go from 846 and you can be wrong on the trade, drop to $8, drop to $7.50. You're still making your 7%. Your break even on the trade is $6.91. $6.91. That's your break even. So that's so let's go back and look at the chart. So your break even is off the charts. I don't even have it on here. Let me see if has it been that low before? Early on when it started off, right? But look at this. So your break even would be down here. There's your break even. So you may think, well, Bruce, I don't know if I'm that conservative. 7% is cool, but I think the stock's going to go higher. Well, okay, well then you could set it up. I would still encourage you to say take a hedge, but maybe take the hedge at the $10 range. And now your ROR, your rate of return, goes from a 7% return to a 25% return. But the key is the key is now your stock has to do something. So now here at 750, your stock didn't have to do anything. It could actually go against you down to 750 and you're still making 7%. You choose a higher strike price at $10 a share, which chances are it could probably get there. Will it get there in 28 days? It might. If it got to 10 or higher, you're locked in at 25%. If it did not get there, but it went up, let's say it went up, but it didn't quite get to 10. Well, you reduce your cost basis. You're keeping your stock that you bought for $8.46, but now you've reduced your cost basis down to $7.91 as opposed to $8.46. So if it didn't go to 10, you're not going to get called out. You're going to just keep your stock position, and then you could do it again the next month. You could maybe write the 10s again the next month. It'll probably be a larger premium. So these are things you can do. So that's if you want to say, you know what, I don't want to do a non-directional trade. I want to have the stock do something because I want to get a bigger return on this, on my money. Make sense? Hopefully it does. We'll open up for Q&As in just a bit. So let me talk about one that I've been keeping my eye on. That again, it's all about timing. I haven't not entered the trade yet, but I'm looking at it. I'm looking at it for Monday. It's called Fubo. So Fubo was we talked about the Reddit thing, and we talk about all the short sellers. So if you take a look at Fubo, it had the highest short interest, only second to GameStop. So I'm interested in it. I like the story of Fubo. I think this thing goes higher. And the thing I like about short interest, so when you see a higher short interest, if it reaches a certain KPP, a certain key pivot point, all of a sudden the shorts, the people that short the stock, they get squeezed and that thing pops like a teenage zit. And that's what you want. You want that thing to boom. You want that thing to move up. So these are the things you're taking a look at. So look at this. So it's been in a downward trend. Now they have earnings. This is something else to note. They have earnings coming out when? They have earnings coming out on May the 11th. Okay, so that's important to know. Is it before or after the market? Let's take a look. That happens to be after the market. So you want to know that. You want to know, okay, so 5/11. So May the 11th, they have earnings. That's important to know. So when we take a look at this, we start to see it moving up. It's trading at $20.66. What do we do? Okay, we can hedge ourselves, right? So we can buy it for $20.66, keeping in mind that they have earnings on May 11th. I want to hedge myself though, in case I'm wrong on the trade. So maybe I could put a stop loss on this thing, right? I can go ahead and take a look and say, okay, if it breaks below a certain price point, I'm going to get out of this trade. I'm going to just wash my hands and say I'm wrong. That's smart to do. But let's make sure we have a little bit of insurance, right? You don't drive a car without insurance. I hope not. So you're not going to trade without insurance. I hope not. So we have Fubo trading at $20.66. So we can take a look at, you can see here, these ones in yellow are called weeklies, guys. These are weeklies. The ones in white are called monthlies. So there's a lot of different opportunity here for Fubo. Look at that, 8 million shares traded. So when did I say that their earnings was coming out? May 11th. May 11th. So May 11th. So I don't want to go on, if I'm going to short a call, I'm going to buy the stock and short a call. I don't want to go into earnings. So look at this. This is the May the 7th. These are weeklies. I can choose the weeklies and I can go ahead and say, I think the stock's going to go up, right? This is my thesis. I can go ahead and actually sell. I could sell the weeklies that expire on the 7th. So well before the earnings date, but I'm reducing my cost basis by $1.07, maybe $1.08, maybe $1.09. I'm reducing my cost basis. Let's call it $1.07. So if I buy the stock and for $20.66, I'm shaving off $1.07 and $1.08 off of the price of $20.66, which is cool. That's like insurance. And then by choosing the 22s, let's say before earnings, it runs up and it goes to $22 a share before earnings. Okay, then I'm going to get called out on that particular trade. And my percentage return, if I got called out, obligated to sell at 22, but I took in my credit, my return is going to be 14%. I bought the stock for 20.66. I took in my credit of $1.07. I'm selling it for 22. So really it happens to be like 23.07 that I'm selling the stock for. That's a 12% return in 14 days. Whew, 14 days. That's pretty cool. But take a look at this. Let's power the options though, because sometimes it makes sense to do these stock where you're not buying any what they call extrinsic value. You want to write down that terminology. You learn about that later. Extrinsic value and intrinsic value. So when you're buying the stock, it's all intrinsic value. But sometimes it still makes sense to buy the stock or to buy the option. Let's take a look at it. Let's say we don't buy the stock. Let's say that we buy the monthly options. And let's say that we buy the in the money. So there's what they call in the money, at the money, out of the money. So because the stock is trading at 20.66, so this is the way people learn, right? They learn by actually doing it, right? So the stock is trading at 20.66. We're going in the money. We're going in the money. And here's the other key thing that you want to write down. So those of you that are trading options, you never want to really own more than 10% of the open interest. So this is called open interest. This is all the open interest. This is how many active contracts you have. 2,514. You don't want to own more than 10% because then you become the market for that particular option. That's not what you want to do. When you're selling, it's a different story. But when you're buying, keep that in mind. When you're buying the option, open interest, you should not go over 10%. That will get you in trouble if you do. So when we talk about this, so we're cool with this. We take a look and we say, we're going to go in the money. Stock's trade at 20.66. We're going to do the $15 call option. That gives us the right to buy the stock at 15. It's going to cost us $6.20 to be able to do that, to give us that right. So we're buying it for $6.20, this call option, but we're not going to keep it directional. Now what we're going to do is we're going to come over and just like we did this with the stock position, except our cost basis is only $6.20. It's not $20.66. So $6.20. We're going to come over here and do the same thing. We're going to sell the $22 call option, the weekly that expires before earnings on May the 7th, bring in our $1.07, and that reduces our cost basis. Let's see here. We're buying it for $6.20. We're bringing in $1.07. Our cost basis on the trade is what? $5.13. $5.13 is what we're paying for that trade. That's a total, that's a TCOT. The total cost of trade is $5.13. If this stock trades above your $22 strike price, which is what we sold, you know what your percentage return is? Let me do the math for you. 36%. 12% was cool. 36% is better, and you have less capital on the line. 36% return in 14 days. That is cool stuff. And if it doesn't go to 22, which Bruce, what happens if it doesn't? What if it goes up but it doesn't quite make it to 22? Who cares? Who cares? You're still making money on your long call option, and you're keeping that entire credit that you took in of $1.07. You're winning on both sides. That's what we're talking about. That's what we're talking about when we're talking about using options to be able to hedge the marketplace. You like that, guys? Give me a thumbs up if you like it. Yeah,
brother.
Good stuff. Okay, so let's talk about a stock that is very popular. I'm taking a look at. Again, it's all about timing the marketplace. And Joe, you're going to like this. It's all about patterns, right? So that's the whole thing about the market. The market's, people think, oh, you have a degree in finance, you study finance, that's why you're good at the markets. No, I understand people. That's why I'm good at the marketplace. The markets is all about market psychology. Understanding about how people are thinking, how stocks are going to react. That's why I tell people all the time. I say, focus on a handful of stocks that you become intimate with, and then you know the direction of those stocks. And if you're an options trader, it's a little bit more difficult because now you have to, another layer is you have to start to study the movement and how the market maker prices that particular option when a stock hits a certain price point. But it's well worth it. It pays out. So the stock I'm going to talk about here is none other than Tesla. none other than Tesla. Now let's take a look at Tesla. I saw baby Joe's eyes light up when I mentioned Tesla. He likes Tesla. So let's take a look at this. Let's take a look, and this is what you take a look at with patterns. So you see where the stock is trading at right now. But let's add some clarity to this thing. We have earnings coming out on 4/26, April the 26th, which is Monday after the bell.
Mm-hmm.
Now, typically, I don't like trading through a catalyst. I like trading up to a catalyst, but that doesn't mean I never do it. If it's with risk capital that I'm okay with losing, then I will do it. So I am thinking about this trade on placing this for Monday. And there's a lot of reasons, but let's take a look at Tesla from a technical perspective. I'll leave the due diligence to you, but let's look at it from a technical perspective. And this is all about numbers. And I know Joe's going to love this stuff because he's all about numbers. Look at this pattern right here. So look back here, back on March the 30th, and it was around, let's just call it $600 a share. It was a little bit less than that, but let's just call it $600 a share. And it ran up to 704. Then it pulled down. Traded sideways, 674 or so. Then it ran up, 773. And now it's pulling down again. Now, why do I bring this up? You have to be able to recognize patterns. Kids are really good at recognizing patterns. And if I ever have questions, I always go to my 4-year-old. She knows. So she's good at recognizing patterns. So when we take a look at this, if you take a look at, here we are now this is important. It's not just looking at the chart, because things happen over and over again in cycles. If we take a look at this back on March the 30th, and we take a look at where it ran, we're looking at about $104 point movement. So write that down, $104 point movement. And it took it about what, 7-8 days to do. 7-8 days to do to make that run. That's important to know. And then it traded sideways. And it traded sideways for a length of time, probably about the same length of time that it is right now. And then it ran up again. And it went up and made about another $9,600 movement. So almost the same, about 104 here, about 96 to 100 here. And now we're trading sideways again. So what does that tell you? If things repeat itself, and I like the chart, I like where it's trading over my 50-day moving average, which I like. If we take a look and we zoom in here, we can see that we just crossed over from the 8 and 21, which I love. I love the setup. I love the technical setup. If I'm wrong on the trade, I'm only going to trade with what? Risk capital. If I'm going to carry it through the earnings, it's only going to be risk capital. So if I wake up in the morning, it's not going to wreck my world. It's going to be, shit, I missed up on that one. But I'm not going to worry about it. But I think the chances, and I think the probability is high that it performs as it did here, pull it back down, here, pull it back down. I think the probability is in our favor that we get a nice run. So what type of run do I think we'll get? Well, if we base it on a 90 to 100 point move, that puts this stock, takes it from where we're at here on a breakout, takes it to about 829, 830, right about. Right about I'm sorry, not 829. Yeah, right about 829. If we see that same movement. So this kind of tells me, so we'll break past this. This kind of tells me if we get that type of a movement, what option am I going to choose? Well, I can take a look. And again, this is going to be risk capital. I can take a look at the monthlies. So earnings is going to be on Monday after the bell. So I'm giving myself extra time on this. Again, this is going to be risk capital only, but I'm going to take a look at I don't want to go too far out of the money unless I know the stock can move. And even with Tesla, I still don't want to go too far out, because if I'm wrong and I'm way out of the money and the stock goes down, I lose the entire risk capital, which I'm okay anyway, but I don't want to do that. So I'm going a little bit. I'm not going to have the stock have to really work to make a pop. I'm going to put it at 740. I'm going to put it at 740 is the call option that I'm taking. Now, when you start learning about intrinsic value and extrinsic value, when we take a look at this, if this stock gets to let's say it gets to 829 based on what we're talking about, based on where it's trading at right now, 729. And let's just call it a 100-point movement based on what we saw with the patterns before. So 829. If it gets to 829 before my expiration date, this 740 call option will be worth how much? Anybody? $89 a share is what the intrinsic value is going to be worth. Intrinsically, I'm not even counting the extrinsic value. If it makes that move before my expiration date, this is going to be worth $89. That will give me 107% return on this trade. Not too shabby. Not too shabby. So that's kind of cool. Let's take a look at some more. So another one that I've been watching is one that, I don't know how many of you guys trade SPACs, but this falls into that category. So this one is IPOE. IPOE. Now, technically, I like it. I like the fact that it ran up. A lot of short sellers have been involved. It's been pulling down. The short float on this is about 30%, which is high. But that's good if it does make a move in the right direction. When we start to get a move up, we get a short squeeze. And this thing, boom, it just pops up to the upside. So here we're taking a look at this particular trade, downward movement, but look what we see recently. We see it bottom out and we see it start to move up. So we say, do I want to take a chance on this? Do I want to take a chance on this trade? So let's say you've done all your due diligence. You see the trade trading at 16.17. What else could you do with this trade? Well, let's say that you like the trade. You say, man, I see it moving up. I like the story behind it. I'm going to buy 1,000 shares of it. What would that cost you for 1,000 shares? So now I'm going to introduce a different strategy to you. There's so many strategies in the world of options. If you know what you're doing, you can really secure yourself and lock in some things. So if you take a look at this and you say, well, I want to buy it at 16.17. I'm a long-term investor. I'm going to buy it at 16.17. I see this going higher. That's over $16,000 is what you are investing on this particular trade. And again, this could be any stock. I'm using this as an example because it's my active watch list that I'm looking at. I figured if I was going to do an event for you guys, I might as well go ahead and leverage my time as well. So I'm doing it on things that I'm looking at. So $16,000, and you need the stock to do what? You need the stock to go up is what you need. You need the stock to go up. But here's what you could do. You could take a look at this. You could take a look at this. We're seeing it break above. We could go ahead and say, instead of buying the stock at 16.17, why don't we do a different type of a strategy than what I've introduced to you guys before? Still a very non-directional trade, but we start to get some consistency. So if we take a look at this trade, we're at 16.17. This is $15 a share right here. This is 15 right here. Now I'll show you why I'm showing you 15 in a minute. There's $15 a share. So keep in mind, here's the premise of this. You've done your due diligence on this stock. You like the story. You like the fact that it's pulled down, but now it's breaking back up. And you see this as an opportunity to say, I want to buy this and I want to do 1,000 shares and I want to hold it. But let's say you have like Corey. Corey says, I like it too. And I want to buy it. But you know what? I remember Bruce teaching something where I can set this up and make money on this trade as long as it stays above $15 a share. I'm making money. I don't have to worry about the direction of it. You know, let everybody else worry about that. If this thing goes up or down or whatever, I'm locking in profits as long as it stays above $15 a share. And even if it breaks below that, I have my break even down around $14.50. I mean, the stock has it been to $14.50? What's the low point here? This is $14.52. $14.52. So you would have your break even, and the stock's only been to $14.52 in this scenario here. So how do you do this? You come over here to the option chain. Remember I said we had calls on this side and we have puts on this side? We're looking at the $15 put. But remember that chart I showed you early on where it said if we're selling puts, if you're shorting a put, you're bullish. Because everybody always says puts are for bears. No. In this scenario, we are bullish. So we're selling the $15 put. We're bringing in 50 cents or $50 a contract. And I said, what did I say? I said that we were looking at 1,000, buying 1,000 shares. So every contract represents 100. So we would need how many? We would need 10 contracts to go ahead and satisfy that. And we would bring in $500. $500 on a trade. So this is income. This is like a rental property, right? This is income. You're making $500 on this trade. You have tied up really, I mean, you really don't, it depends on how you have your account set up. There's other things you could do where you have very little tied up. But if you were tied up and it was no margin whatsoever, you're looking at $15,000 that's tied up. $500 on $15,000. Who's going to not take that? And the stock it's a stock you believe in. It's a stock you've done your due diligence on. You believe it's going higher, but you've set yourself where all it has to do is trade above a certain price point. In this case here, $15 a share. You get a little bit of that fluctuation in the market. You don't care. You want to own the stock anyway. So if it traded down below 15, they're going to assign it to it, but you're not buying it at $15 a share. You're buying at 15 minus your 50 cents, which puts you at $14.50 where the stock hasn't been anyway on a stock that you want to own. Now, $500, you may say, well, $500 doesn't sound really sexy to me. This is one. What if you're doing 10 and you're making $5,000 a month on that? 10 that are doing something like this. Does it sound a little bit more sexier? These are things that you want to start taking a look at. These are things that you want to start taking a look at. So let me go back to kind of like the catalyst, a catalyst play, NDRA. And so on this particular trade here, Indra Life Sciences, this is a technical play. A lot of you know I really like to take a look at reward to risk. So it's pretty easy for me to go ahead and say it's breaking to the upside. I can understand that, hey, my risk level might be right down here below this wick here. So like at 224. So if it pulled, so the whole premise on getting into this particular trade, you know, there's different catalysts coming up. They're specializing, they're bringing like what's supposed to be really groundbreaking technology, where they're developing technology to visualize tissue like MRI at a much, much lower cost. And the FDA decision is supposed to be imminent. It's coming up very, 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 very soon. So this would be another catalyst trade, but also a reward to risk. So if I got into this trade here, I'm not in it yet, but I'm looking at it. It's on my watch list. If I do it, I like the technical setup. If I had my stop at $2, because people are saying, well, how do you know what your position size is going to be? You have to first take a look at the chart and say, where is your uncle point? Where is the point where you are going to say, boom, I'm done with the trade, I was wrong. So everybody, you look at the charts differently, you're going to get better and better as you go along, looking at more and more charts. But let's say it was right around 220, you're entering the trade at 240. So that's a what? That's a 20-cent delta. So that's where you find out how much do you want to risk? You divide that by your 20-cent delta, and that's going to tell you how many shares that you're allowed to buy for this particular stock. So you don't want to, so when it hits $2.20, or $2.19, it breaks below 220, you're not sitting there thinking, oh my gosh, I can't afford to take this big of a loss. You decide those things ahead of time. So this is the thing I like. Reward to risk, I think, is huge on this. I like the fact that it has a catalyst trade. I think this thing can go much higher. And I put my stop at 220. I break below that, I'm done with the trade. I'll say, hey, I was wrong. So, covering a little bit of everything. So we're talking about risk management. We're talking about position sizing. We're talking about option trading. We're talking about different strategies for options, whether you're buying a call or selling a call. How do you hedge yourself? How do you make a non-directional trade? Now I want to introduce you to something that even probably my most senior traders on this call tend to overlook. Why? That's because it's stuff you have to do. It's homework you have to do. So let me illustrate what I'm about to show you with the stock called Roku. So Roku, here's Roku. So when we take a look at this, we see Roku trading at $356.87. That's what it's looking at right now. What I want to talk about is how do we go ahead and do two things. How do we make sure that we can, even if we're wrong on the direction, we still make money on the trade? There's a couple things to take a look at. So one of them, and you're going to want to write this down, one of them is called IV, Implied Volatility. I would have known. So this is something you should look at if you're trading options, Implied Volatility, because this can help you or it could hurt you if you don't know what you're doing. So when we take a look at this, we're taking a look at, I like the technical setup. I like the fact that Roku pulled down. I like it goes up, it pulled back down. It looks like it's about to cross again to the upside. I like all this. Technically, I like it. So let's just say we're on the same page and you like it too, technically. What we want to be able to do, and I'm going to stop share here. What we want to be able to do is we want to take a look at implied volatility. Actually, I want to pull that up again. Hang on a minute. What we want to do is we want to take a look at implied volatility. So Thinkorswim platform does a pretty good job. So if we take a look and we say, let's look at the Junes. Let's not look at May's. Let's look at the June timeframe, a little bit longer term expectation. Let's look at the June timeframe, and let's look at the little bit of out of the money, because I think it's at the bottom. I think it goes higher, so we're going to choose a 360. So write this down. The 360s, they're going for 30 by 31.40. 30 by 31.40. Now let me change it over where we're taking a look at implied volatility. So this shows you implied volatility, and you can see implied volatility is about 56%. Now people say, well, yeah, that's high or that's low. I hear it all the time. How do you know? You can't tell by this. This is just a raw number, right? So you can't tell by just going ahead and looking at what that number is on there. What you have to do is come over to, now someone said the other platform had it. I don't know if it does or not, but I'm going to go to what I have. And I have ivolatility.com. So let's take a look at ivolatility.com. Okay, so here's ivolatility.com. We put in Roku. We take a look at down here, implied volatility, not historical implied volatility, but IV, implied volatility. And we're looking at we're going out about 60 days. So this is the term that we're looking at, the 60 days. And there it is. There's the current, just like what it said on Thinkorswim, 56% for that particular option, 56%. But that still doesn't mean anything right now. But here's how you figure this out. You got to take a look at the range. So the range has been from 55.24. You guys see that right here? 55.24 to 83.95. So there's the range for you. So this is going to tell you a little bit something about the implied volatility. So we're taking a look at that, and that happens to be, if you take a look at 83.95 minus the 55.24, that gives you a 28.71. That's the length of that yardstick, right? So that this 55.24, if you drew a line and this was 55.24, this is 0. This represents 0, right? If you took a look and you had that same yardstick and you're looking at 80, this is 83.95, this represents what? This represents 100. 100 and 0. So we need to find out the percentile that's at. This 56.55 doesn't tell us anything. It depends on where it's been before. So we have 55.24, we have 83.95. This length of this yardstick is 28.71. Now, if we take 56.55 and we subtract the 55.24, that bottom number there, this bottom number here, that happens to be a 1.31. 1.31. That represents, if you take 1.31, divide that by 28.71, the length of this yardstick, that means that Roku right now, that particular option is at the 4.6 percentile. That's low. So the rule of thumb that I like is anything that's really below the 30th percentile, that's below the 30th percentile, that's the time to buy. When it starts to go higher, that's the time to sell. That's where you're going to get the biggest premium. So when it's down low, below the 30th percentile, here we're at the 4.6 percentile, that's the time to buy. Because they even kind of chart it out for you as well. Now, why do I say this? Because you can have what they call an implied volatility suck, meaning that maybe you weren't paying attention, you bought the option, and how many of you have had the stock go up in your favor? You're buying the call option, it goes up in your favor, and you're like, how come I'm losing money? It's because the market maker already had that thing so juiced up They are now letting the air out of the tires. And even though you got the direction right, you didn't pay attention to implied volatility and you're getting squeezed on that. The same thing can happen on the other end where you got a low implied volatility and your stock doesn't even do anything. It stays flat or even goes down a little bit. And you're like, whoa, my option's making money. Because now they're starting to add that implied volatility, that juice back into the option. So it doesn't require the direction. So if you can get the direction correct and you can get the IV correct in your favor, that is a recipe. You get both of them. That's a recipe for success. A recipe for success. So we have on Roku on that option, it's at the 4.6, less than 5%, the fifth percentile. That to me is something worth taking a look at. So if we look at this, now we're not done yet. Look at this. If we take a look at this, hope you guys are enjoying this and I hope you're getting some value out of this because I'm trying to drop some real gems on you. If you take a look at this, so we've already looked at implied volatility, boom, off our check mark. Now I want to take a look and I want to say, what option do we want to get involved in? Well, let's say that we take a look at, well, we already took a look at it, right? We looked at the Junes. We looked at the Junes. We're looking for this thing to go up. So here we have, let's just call it 31. We can probably get less than $31 a share or $3,100 a contract. But let's just say that so one contract would be $3,100 for one contract. But yeah, I've always been of the belief, man, it's the same way I do real estate investing. I like to borrow somebody else's money to buy properties. Here, I want to do the same thing. I want to borrow somebody else's money to pay for this or a portion of it, this particular contract. So here we are. Let's just call this, let's just say that we're buying this. Write this down, guys. Let's say we're buying this for $31 a share, $3,100 per contract. But how do we get somebody else to pay for this? Well, here's what we do. So we're buying this one. We're BTO in the June 360 calls. And now we're going over, look at this. We're staying with the Junes. We're selling the June 320 calls. Remember I said that was bullish, right? We're selling the 320 calls. So now when we sell, what happens? When we sell, we are bringing in a credit. So we spent $3,100 for the contract. We are bringing in roughly $1,500. Let's call it $1,500. That's a credit. We're bringing in $1,500 into the credit off of this. Is that awesome or what? So look at this. That's the 320s. 320 is where's 320? I gotta expand the chart to bring up 320. 320 is right down here. 320 is down here. So our belief is the stock goes higher. We're selling the 320 put to be able to go ahead and subsidize this. And that brings off almost half of our cost is done, but we're not done. Let's take a look at this. What happens now? So we went ahead and we bought the June 360s for $3,100. We sold the 320 puts for $1,500. And now we're going to go ahead and take a look at the Mays. We're taking a look at the May. We're going to sell the May 390s. Look at that. The May 390s for like $1,300, $1,250. Let's say we bring in $1,250. So we'll do the math on that. We got $1,250 that we're bringing in a credit from selling the Mays. We're selling the June 320 puts, and we're bringing in $1,500. So we got $1,500 credit there. We got $1,250 there. We got $2,750 of credit. So we're paying $3,100 and we're bringing in $2,700. You gotta like that. We've just reduced our cost basis significantly.
Mm-hmm.
Make sense?
Sense.
Yeah. For some of you, it's not going to make sense all at once. Understand this is how we trade, though. It's not a matter of saying, hey, here's a good trade to make. Let's go ahead and buy directional. Even if you're trading the option, why not hedge yourself where you can reduce that cost basis? So before I had $3,100 on the line, now I have what? $250 on the line. That's the way you trade. That's the way you reduce your exposure in the marketplace. That's what we're talking about. That's trading. Let me bring up one other one. I think I got one other one. I actually got two. me bring up this one. So this is really kind of a reward to risk factor. I like the security space. Here's FireEye. So FireEye's been on a little bit of a downturn move, but you have to see things before they happen. It's no good for you to look back and say, oh my gosh, remember when that stock was at that price point there? Now it's up, 30 points. It happens, right? Because you don't watch the charts. But if you take a look at this, you see this downtrend, and you start to take a look at, now we're starting to get, look at this movement here. We're starting to get a nice little move to the upside, right? So I think if we have our line in the sand on this particular trade here, 2028 is where it's going. It has earnings on 427. You can put a stop so you can get in this trade and say, well, you know what, Bruce, let me go ahead and do this. It's at 428. I'm going to put my stop at $20.10. You can put a stop on there where you're controlling your risk. And I'm getting that by taking a look at this area here. This was 2011 was the low point. So just a penny below that. If it breaks below 2011, hits 2010, I'm done with the trade. I'm not going to sit around justifying it. I'll be done with the trade. So that's, to me, is a good reward to risk ratio on this trade. And you don't have to even do the stock again. You have options, right? You have different ways you can trade this. You don't have to put $20.28 on the line. You can go back and take a look and say, let me stay with the Junes. Let me do the $15 strike price. There's plenty of liquidity in that, and pick it up for $5.40. So you could do that. And you can even add on another layer and say, let me sell the Aprils on theirs. So this is the Junes. Let me sell the April and hedge myself a little bit. We'll go with the weeklies, 6 days until expiration. And we'll take a look and we'll sell the 21s. And we'll bring in another 52 cents. So that shaves off from our cost basis there. It shaves off from our cost basis, and also it protects us a little bit, and it reduces our cost basis. So if it goes and it trades above $21 a share, so what? You're saying, well, gosh, Bruce, I'm agreeing to sell for 21, and it's already at 2028, but you're taking in 52 cents. So you do the math on that, your return is going to be 23% just for it to move over 21. And if it doesn't move over 21, you have a little bit of a hedge on there. So many things that you can do in this world of trade in the marketplace. One last one, and then I'm going to introduce my brother Gene, because I think it's also important to talk about trading as a business. And my guess would be very few of you actually trade as a business, and I want to make sure that gets changed as well. So this is something I see my daughters use a lot. I don't know if I really like it, but they've been playing this game, Roblox. You guys heard of it? The company Roblox? And so when this came out with an IPO, people got all juiced up and they said, oh my gosh, I'm going to trade the IPO. And I even said, I was on a Clubhouse call and I told folks, I said, I'm not going to do it, because typically what happens with stocks is that when they IPO, not all the time, but a lot of times, is that stocks will pop on the opening and then they fade and they go down for about, and I told guys this, I said it goes down for about 4 to 6 weeks is where it trades to the downside. Then it starts to find a base, and that's when you can go ahead and get into the trade. Don't be so anxious to get in. I told people that. Did they listen? I don't know. I hope so, because it popped up to $92 and faded as low as $60 a share. But now, and I said it before, timing is everything. And now it's something that has caught my attention. And I take a look at it and I think to myself, looks pretty good from a technical perspective. I like the baseline here, the little flag that it's presented. It's starting to move up. They have earnings on May the 11th, which is important to note. So May the 11th, after the bell, they have earnings. So how can we participate in this? If it looks good technically, and I see it just trading on Friday, closed above my 50-day moving average, technically I like it. And I always say, sometimes people ask me, say, how do you find out what to buy? It's right. Look at the things that you use. And remember I said before, I said those of us that are making money in anything, it's the ability to see around the corner. So while I may not be real crazy about the idea that my kids are using Roblox, and I limit that, believe me, I limit that. They're probably at home right now taking advantage of the fact that I'm not there watching them doing the game. But you have to take a look at those things. As a trader, as an investor, you have to say, well, there happens to be a trend and it ain't going away. So these are things that catch my attention, but it's also timing. It's also timing in the marketplace. So now I think now if you ask me on that, several weeks ago, I said, no, not for me. Boom, X. You asked me now, it's on my radar. Now, how do we set this up? So the stock is trading for 71.78. Let's go back and take a look. And they have earnings coming out. When did I say? They have earnings coming out on May the 11th. Let's say that you go ahead and you buy the $70 call option. A lot of juice in that. 16,000 on the open interest. Let's say that you buy the $70 call options, and the $70 call options are from 730 to 750. So you buy them, let's say for 740. So write that down. You're buying it for $7.40. But let's not end with that. Let's try to shave some of this off, right? But keep it in mind, they have earnings on the 11th. So let's come down and say on May the 7th, let's take a look at the weeklies. Let's sell the puts, the $60 puts. Sell the $60 puts. Where are we at here? Actually, you know what? I don't want to sell the $60 puts. I want to sell the same as this one here. I'm going to sell the $60 puts for the same one I'm buying. So I'm bringing in $1.80, $1.85. I'm bringing $1.85. The ask the bid is $1.80. The ask is $1.90. I'm bringing $1.85. So I'm shaving off $1.85 there, and the stock hasn't even been to 60. It was down. The lowest it got was $60.50. So I'm selling. So when I'm selling the $60 put, I'm obligating myself to buy it at 60. But my price will be 60 minus the almost $2 per share that I'm taking in. So it'll be a little bit more than 58 bucks that I'll pay for this if it got put to me. I don't think that will happen though. But if it did, you got to be prepared for that. So you're selling the $60 puts. You bought it for $7.40. That's pretty cool. You took off $1.85. But let's take a look now at the May 7th, right? And let's look at selling the $80 calls. So we're selling an out of the money call. We're bringing in, anytime you're selling, you're bringing in money. So you're selling, they're giving you $1.15. Let's say they're giving you $1.15 for this. We took in $1.85 for the $60 puts. That's a $3 credit off of the $7.40 that we spent, which makes our total cost basis on this trade $4.40. Boom. That's what I'm talking about. So trading has so many different levels. If you know what you're doing, there's so many different ways to protect yourself and have somebody else pay for this. And if you go back and you look at the implied volatility which I won't do right now, but you look at the implied volatility, I want to say the reason I did that is because the implied volatility was higher than what I normally like to get on a trade. But this is the way you reduce your cost basis. This is the way you kind of shave off the premium that the market maker is charging you. These are things, guys, that if you do it right, it will actually change. It will change the way you look at the marketplace. And if you understand about having consistency, that's key in this business, having consistency and understanding the rule of 72. These are things that are going to make a difference for you. Creating non-directional trades, it's what I love to do. So with that being said, what I want to do is before I open up for Q&As, I want to turn it over to my brother, Gene. Gene's going to talk about trading as a business. And it's important to pay attention to this because those of you that are putting all the efforts into your education, you're putting all the efforts into being able to go out there and look at finding the right trades and build your portfolios up. Why not get major, and I'm talking major tax advantages, and trading as a business? It's one of the greatest businesses, in my opinion, that's out there for us. So with that being said, my brother, Gene, go ahead.
All right. Brother, can you hear me okay?
Yeah. Very good.
Hey, well, I just wanted to, Bruce, I just wanted to say, man, that was some great information. And I know everybody's probably thrilled to death. Heads are spinning, but just stay with us, everybody. Stay with us because it's just going to get better. So I want to start out by saying good morning and good afternoon, depending on your time zone. I just want to go ahead and say, welcome to webinar land, right? My name is Gina Dinger, for those of you that don't know me, and I'm here to deliver some exciting information on stock market trading and why, as Bruce said, setting up your trading business as a business is the right way to go. And I'll show you that having a stock market trading business can be the very best business in the world. Within this section, I will also deliver a ton of insightful and helpful content and explain why Bruce and I believe that learning and developing a skill set in the trading stock market arena is well worth the time and effort. I mean, who would have thought that we would have gone through a global shutdown? I mean, we all went through it, right? And some of us were forced to work from home. And if we were that lucky to have that job or position that would allow us to do that, that would be great. But it didn't happen for everybody. A lot of people got hurt. If this pandemic has taught me anything, it taught me that, man, you got to understand that if you're not set up the right way, you can actually go ahead and be hurt and crippled even. Every job to me is essential. But this pandemic had a list, a list that was deemed worthy of being essential. You know, in this pandemic, you got to understand that you've got to be willing to adapt and pivot. Because like I said, some of these jobs were affected, but not all. Some got just slammed hard. This brings me to the topic of trading the stock market. As a trader, I was not affected at all by this pandemic or its lockdowns. In fact, I, like many other traders and my brother Bruce, we were already trading from our home offices or wherever we were in the world at that time. If you can connect to the internet, you're in business. You're able to trade, whether that be with a laptop, smartphone, or tablet, you're in business. Now, the question comes down to this. What do you want? Why are you here? What is it you're looking for? So, did you know, and you've heard this from Bruce, did you know that you can actually have more losses than wins? It's true. And still make money? It's true. It's all about what? Learning to minimize those losses. And yes, you will have losses. Knowing when to get out before you get in, that's key. Getting into the trade is the easy part. It's knowing when to get out. That's the tough part. This is why it is so essential to learn and develop this skill set. When you learn, train, and develop this skill set, you can make money whether the markets are going up, down, or even sideways. There are many times when you can make more money faster as the markets are going down. Yes, you heard me correctly. And this is what Bruce taught you already. It's called shorting the market. Learning to trade options is a great way to leverage yourself in a typically expensive stock, such as Berkshire Hathaway at $352,000 per share. You can purchase a call option from the same stock, but not for $352,000, but leveraging in for a mere $258 for a single contract that covers 100 shares of the underlying stock. This is a great way for you to be involved with a fantastic stock without breaking your bank. Now, the two types of option contracts are put and call options, both of which can be purchased to speculate on the direction of the stock. Call options can be purchased as a leverage bet on appreciation of an asset, while a put option are purchased to profit from prices going down. Have you ever heard the news that said we're in a bear or bearish market? What the heck is that? That's put options going down. Or maybe the news said we're in a bull or bullish market. What's that? That's call options going up. Now, the easiest way to remember this, and I'm just going to demonstrate for you. So you're going to probably think this is kind of funny and ridiculous, but here's the telephone. When you want to make a phone call, what do? Call up. You're done with the phone call, put down. Call up, put down. You'll never forget that, right? Now, you may be saying, okay, well, how about this bull and bear market thing? How do I remember those two and not get them confused? I want you to think of a bull with long horns. How do bulls typically attack? They attack by going up. They're striking going up, right? How about a bear? They're on their hind haunches, and how do they go ahead and attack? They got their paws in the air, and they attack by striking down. Bear market striking down, right? I know it looks silly, but you'll never forget the two. You'll never forget the two. So with that being said, as trading becomes more accessible as a result of the ease of online discount brokerage firms, more and more people are participating in the stock market. However, as an individual or sole proprietor, traders cannot take advantage of some of the tax advantages and asset protection strategies that are out there for who? For the big companies. Now, here's my disclaimer. What I'm about to share, I'm not a licensed financial advisor or CPA, but this is for over 25 years of having multiple businesses, successful businesses, and I am going to talk from the heart of what I do in my businesses, including my trading business. So this is exactly what I do. This is exactly what Bruce does as well. So with that being said, always check with your local financial advisor, your local CPA, and here we go. Buckle up. We're going to go deep. So make sure that you're ready for some great copious notes. You got to take some great copious notes. So working as an independent trader can be a way for individuals to make extra income. We all know that, even possibly a full-time living. But like any business venture, the income generated from trading is taxable. So if you are a successful independent trader, it can actually create significant tax liabilities for you. Individuals that want to actively participate in the stock market have several options. You can trade as individuals, sole proprietors, or qualify for trader status, or better yet, trade through a business entity like what? Like an S Corp, an S as in Sam. For the active trader, creating a legal trading business will often provide the best tax treatment and asset protection. Keep in mind that the Internal Revenue Service, that's the IRS, does not recognize trading as a business activity. In fact, all income from trading is considered unearned or passive income. The IRS sees individuals as investors, and the trading activities that are done by these so-called people without a business structure, they're going to be looked at as long-term capital accumulation type gains. Individuals will only have limited deductions that are afforded to the W-2 wage earner, generally limited to mortgage interest, property taxes, and charitable deductions. Most deductions are restricted to a percentage of adjusted gross income. Now, the biggest tax issue you will face as an individual trader is that deductions for trading losses are limited to gains. After that, only $3,000 can be deducted against ordinary income. Now, for this reason, this is why it is so important for you to either qualify for trader status, which you can see the qualifications by going to IRS Publication 550. Again, that's IRS Publication 550 for trader status, or for whatever reason you don't qualify for trader status. Another way to ensure you're receiving similar tax treatment is to create a separate business entity. Like what? Like an S Corp, which you will conduct all your trading activities through. Now, as a qualified trader or S corporation, you would be allowed to file a Schedule C, that's C as in Charlie form, and deduct business expenses, which could include education, entertainment, and yes, you're allowed to have fun in this business, margin interest, and other traded related expenses. You can now take Section 179 deduction for equipment used in trading activities. And finally, as a qualified trader or S Corp, you can elect Section 475, also known as Mark-to-Market election. Mark-to-market allows you to change capital gains and losses to ordinary income and losses. Under mark-to-market, traders, that's you, are not bound by the $3,000 net loss limitation. That's huge, right? For active traders, the benefits for qualifying for trader status or setting yourself up as a real business through an S Corp is obvious, right? In reality, only a small percentage of individuals will qualify for trader status. The great news is that by creating an S Corp, you can receive the same tax treatment as a qualified trader without having to qualify. Awesome, right? I know. And having this legal type of entity, the S Corp, usually receives less scrutiny by the IRS. I know, go figure, right? Setting yourself up the right way with a legal entity can now allow your income from trading to be reduced by contributing to an individual retirement account, pension fund. More success could equal more entities. Some financial advisors may suggest forming business structures like that would include multiple entities. Why? Because it's a way of maximizing the tax and asset type of protection. Benefits afforded that is only usually afforded to businesses, but now it's your business, so you're going to have the same, right? So for example, let's say that you want to fund college expenses, or you want to give your children or grandchildren money tax-free. This is a legit way to accomplish this great and kind act. It's your money. Shouldn't you be able to go ahead and help out your family without them being taxed? Well, of course you can, right? You could even help out a family member that is out of work. You have a legit company, a legit business. You could now hire that family member to work for you. You can either hire that person as an employee or as a contractor. It's endless, the possibilities. As we all get a little bit older, we're all getting a little bit older, how great would it be to have your trading business build up your Social Security or Medicare accounts? You're now in total control. How about beefing up your retirement accounts through what? Through your trading business. Are any of you out there a little behind on your retirement portfolios, right? Retirement accounts such as what, G? Such as IRAs, 401k plans can now be transferred into a 401a, a type of pension fund that allows annual contributions and can never be accessed by creditors or through a legal claim. Gene, what's a legal claim? A lawsuit. That's a legal claim, a lawsuit. You're like, oh my God, a lawsuit. Isn't it crazy, folks, that when you have no money, there are no lawsuits, right? But as soon as your bank account looks like it's getting a little fatter, bam, hit with a lawsuit, right? You're now what? You're a target. You're a target. This type of business structure also provides excellent asset protection. No kidding, right? No kidding. So this actually will separate your business from you, the individual. Again, I'm not a licensed CPA or financial advisor, so every state is going to be slightly different when it comes to laws and regulations. So please make sure that you check with your local financial advisors and CPAs for the laws in your area. You know, I've been in business successfully for over 25 plus years, and I have learned a ton, and I'm still learning. I'm a work in progress. Trust me, folks. Tax laws are always constantly changing, and I truly enjoy sharing and teaching, and I believe it's important to help one another. You know, I hope you found this section to be impactful and insightful. And now, brother, back to you.
Good stuff, Gene. Good stuff. Gene gets excited about talking about about the taxes and stuff, but it is true. I mean, I go through. There's only a handful of guys on the in the country that really specialize in trader tax laws. So it's very important that you select wisely, because I've had many people come to me and say, "Oh, hey, I'm a licensed CPA. Can I do your taxes?" I go through Robert Greene with Green Trader Tax firm, and they're based out of New York. And all they do is they take on hedge fund managers and professional traders. A lot of guys don't know that they spend all this time and they're successful trading the marketplace, but they're trading individually. So it is important to be able to have things put into. My guy tells me to put it into an S Corp. That's the best vehicle. So that's what I've done. So it might be different for you. I kind of doubt it, but it could be. But what I would say is take a look into it, because then you start taking a look at not only, as Gene stated, taking a lot of the advantages, tax advantages, retirement plans and whatnot, even traveling. I do business trips now, right? So when I go to different places, it's because I'm looking at a company that I happen to be doing research on. So all that stuff falls under the umbrella of your trader tax status.
No more vacations, Bruce. No more vacations. They're all business trips.
Exactly.
Yeah.
And there are ways to be able to go ahead and and qualify for it. It's not as difficult as you think. There's few that qualify for it only because they don't know the rules. Once you understand the rules, and there's no hard written black and white rules, there's case studies about how many trades that you should be making on a regular basis. But the IRS wants to see it as a real business that's bringing in, doesn't have to be your main income, but it should be a major portion of that. Anyway, good stuff, Gene. What I want to talk about real quick before we go, hopefully you guys have enjoyed this. I want to bring up what I do for, I run a hedge fund and a wealth management practice, but I also, a few years ago, created what I call the Traders Roundtable. And I haven't promoted it for some time now. And I only have really, I want to say I have about 38, 39 students in there. But this is what I'm going to promote for you guys today. A lot of people have asked me, they said, how do I go ahead and trade alongside with you? And I even seen the questions in the chat, which are great questions about, risk and risk management and, even simple things like a journal, and which really is not simple, but it's something that everybody should do. Very few people do it, and there's reasons for it. But what I've done is I've created a Traders Roundtable, and you're trading at the table with me, virtually, of course. And, I've used a private group. I have in the group well over 100 different recordings. I have quizzes in there. I have lessons in there. And that's cool, but I believe it's not enough because I'm a reader and I like to read, but I don't get really the gist of things until I actually do it, which is why my teaching style is kind of like what I did this morning is I walk you through actual trades and I show you the setups. So typically even somebody who's brand new to the marketplace and doesn't have any clue about options, when I outline trades and I say, hey, here's what I'm doing, much like what I did this morning, they're able to take a look and they may not understand everything at first, but I guarantee you, if you're engaged, you start to look at it, you write things down. That's why I kept saying, write it down. You write things down, you look at the trade, you look at it, at what the stock does and you track it. You will get this quicker than what you could even imagine. I've just found that it's the quickest way to learn is being engaged. So I have a section where I have a lot of recorded videos and I continue to record videos and whatnot about the market, about different trades, and I post them in there. But I think really where a lot of the students excel is I have a virtual chat and I put in there information about the watch list. I'll take a look and I say, here's the stocks that I'm taking a look at. Here's the reasons why. So you start to get inside the head of a professional trader, me. And I go through and I actually outline what this trade is going to be. Is it going to be a stock trade? Is it going to be an options trade? What's the risk involved in that particular trade? What happens if it gets assigned to me? How do I unwind the trade? I put those things in there before the execution of the trade. I'll put stop losses in there and everything else. And it's not where I expect you to copy me and follow me. That's up to you. But what it is a think tank. It starts to get you thinking differently. I mean, ask yourself this, all the things that we went through today, how many of you actually even knew about the different types of trades that were out there, the things that you could do, the implied volatility when you're buying a directional call option, how important that is to take a look at. And even now, do you even know how to go back and take a look and measure what percentile it's at? These are all important things. And I have a lot of guys in the room like Stuart Walsh and a few other folks that are professionally traded now. Stuart used to be an executive where he would travel on sales all the time. He's in there all the time now trading. He thanks me. It's almost embarrassing. He says, Bruce, I appreciate what you've done for me. And you know what I charge Stuart when all those students that are in there, anywhere between $15,000 to $30,000. What I want to do though, I'm in a different place at a different time right now. And I've had things happen to me that only a few people know about. Corey knows, Joe knows, of course, my brother knows, but things that have kind of changed the way I think. And I think about how short life is, how when you take a look at life and how short it really is. And they say that you die twice. You die that first time when you physically die. And the last time you die is the last time someone ever says your name. Think about that for a minute. The last time someone ever says your name. So for me, and I can't even tell you why, but it's important to me. I mean, I've seen things in my life that have happened. And for me, it really is it's about not what I've learned, but it's about what I can teach. And I'm not going to say that I know everything, but I can tell you this, there's nobody that studies the market more than I do. Maybe about the same, maybe like Joe, maybe you study it about the same, but no one studies it more than I do. It's in my blood. It's something that, and I think a lot of it's not just for trading, although I am passionate about trading. It's about what it can do for you. My kids have never seen me leave the home. I'll bring them to my office. I'll bring them to work with me. I'll bring them to my where I run my fund. I'll trade from home. Even on my 2-year-old, I have a 2-year-old son. I have 2 daughters and a son. My 2-year-old son, he doesn't have the Disney characters posted around his room. Not that there's anything wrong with that, but he has charts. He has charts where I have them labeled a double bottom, an ascending triangle, a bullish wedge. And it's because I want them to learn. I want it to be like breathing air for them, because this is stuff that people don't teach you until you get older and you seek it out, like what I did. Gina and I went to a class for options. I've been trading since 1981. My mentor was Frank Ammon. I started trading futures, and then I ran a futures desk at a large prop firm. And that's where I saw, and I was the #1 guy there, week in, week out, month in, year out. And I was there for 5 years. And that's when I said, I'm going to start my own fund. But it's not because I'm some genius or whatnot, although I do think I'm pretty smart. But I think it's because it's the passion I have, and it's the way I absorb information. And it kind of led to me to think, when I listen to other people talk about, like the clubhouse room I was in, and people talking about, oh yeah, the real estate market's much safer than the stock market. I don't agree with that. And I'll outperform anybody on a deal. I do real estate investing. So I know what money can be made on real estate investing. It's great. It's great. But when it comes to the market, I'm not looking for a buyer. I'm not looking for a seller. I'm not going ahead and posting my, a bandit sign out there looking for investors. It's all in the marketplace. So even if you weren't to go ahead and do it on a full-time basis, and I don't even really know what that word means anymore, because the money I make is much more than what most people have on a full-time job. But even if you were to do it on a part-time basis, it's not just for you, it's for also, you're changing the trajectory of your family and your generations to teach them, like what I'm teaching my son and my daughters, about being able to trade the market successfully. I'm passionate about it because I want to be able to teach other people that want to learn, because it is about the last, thinking about that last person, that the last time they say my name. I want that to be for generations to come. I want it to be when young Corey Griffin goes ahead and he's sitting around the table with his kids, and they say, "Hey, granddaddy, Corey, how did you become such a successful trader?" Some crazy guy out in San Francisco named Bruce Stinger, mentored me. That's what I want. That's important to me. It's important to me. So for those of you that want to be able to come on board the Traders Roundtable, I ain't charging $30,000 a pop like I used to. Although I could get it, and I've had people come to me and say, "Yep, I'll pay it." I am charging until 2021, the end of the year, $997. That's it. $997 is what I'm going to charge. And I will tell you it's a bargain, because if you think it's too much, there's only 2 reasons that you wouldn't want to do it. You don't believe in me, which is cool, or you just think that you don't believe in the markets. You think that the markets is not something that you can make money out of. But if you believe that the markets can change your life, if you believe that this is something that can have a positive effect on you, take me up on the opportunity and join us. For $997, you can't beat it. So I'm hosting that until you'll be with me until the end of 2021. For those of you, I'm going to open up for Q&A in just a bit here. For those of you that sign up, like, boom, you don't have to think about it. You want to sign up like right away before I end this session, before I end the Q&A session. I'm not going to make it until the end of 2021. We're going to go for 18 months. So a year and a half. And if you can't get this business working with me down and be consistent in your trades, and even those of you that are, because I know there's some of you, because I've met some of you on Clubhouse, that I know you're banging it out, but you look at this as a think tank, as a way to go ahead and have ideas that maybe you didn't have before. And my whole goal is to be able to get you up to speed where you're trading like me. So you can share ideas with the group, you can share ideas with me, and we can just make a killing in the marketplace. It's there for the taking, but it's up to you. So there's the Venmo, guys. If you want to go ahead and do it, go ahead and just sign up, and we'll make this thing happen. The first thing that I'll do is I'll host a webinar much like this, welcoming you guys in. I'll make sure you guys get all set up into the private group. Make sure you have the virtual chat set up, and we'll start rocking and rolling going into next week. So let's go ahead right now. I want to open it up for a Q&A session. Let me go ahead and see if I can unmute you guys. And I appreciate you guys being here again. Where am I at? Let's see here. The mute button is somewhere on here. Let's see here. Okay, here we go. So now you guys should be able to unmute yourself. And if you can, go ahead and let's have someone ask their first question. And it can be about anything related to stock and options. Anybody?
So if you were just starting off in options, let's say you have zero knowledge. Once again, hi Bruce. Thanks for holding this whole online webinar. This is pretty dope. My boy just called me out of nowhere. It's like, hey, get online right now, and sent me the and send it to me. So I had to rush home to sit down with all this information. So I'm pretty much new. He's been trying to convince me into getting into options, and I just want to know, where would I start from zero, a knowledge base of zero right now currently?
Yep. So in my Traders Roundtable, I have from step number 1, introducing what calls and puts are, taking a look at intrinsic value, extrinsic value. So I have all that recorded in a back office where you go through, and I even have a quiz in there to test your knowledge about making sure that you're absorbing it. And then what happens is we jump on a group call on a weekly basis. We jump on a group call, and I give more instruction about different topics. It could be technical analysis. It could be related to options. But then I also save a section where, much like what I'm doing now, where you can ask whatever questions you might have. It might be something like related to, hey, what's the risk when you sell a put? Or what's the risk when you're doing a spread trade? Or it could be about a particular stock. But that's the way you're going to learn. I've found that people learn by, I'll create a watch list, but I don't just create the watch list. I'll take a look and I'll say, this is the trade that I'm looking at doing. And here's why. And then here's how I'm designing. If I'm doing the option, here's how I'm designing the option. Or if I'm doing the stock, here's how I'm using an option to hedge my stock position. And in the beginning, like I said, it's going to be like a foreign language to you. It will be, because there's different things that you'll learn about options, not just intrinsic and extrinsic value, but you'll learn about like Greeks, the deltas and theta. What does theta mean for you as a buyer? What does it mean for you as a seller? And reading a book is one thing. Actually doing it and being under the guidance of someone like myself, a professional trader, it takes you to a whole nother level. And that's why I say, I think in 18 months, you'd get your business off and running. There's some guys that will tell you, hey, set up a paper trading account. I'll tell you my thoughts on that. I don't believe in paper trading when you're trading the markets, and that's all you want to do. I use paper trading accounts, which is most brokerage firms allow you to have a paper trading account. They'll put $100,000 in paper money. You can do that to learn the system, to learn about the Thinkorswim platform or the Schwab platform or whatever platform that you're using. I'll use it for that. I think it makes sense to make sure you're not pushing the wrong buttons and whatnot. But then when it comes down to actually trading, even if you're limiting your trades with a small amount of capital, I think it's better than paper trading, because the emotion is not there when you're paper trading. And even if you have a little bit of money in there, it's just not the same. So I want to use paper trading accounts for new students that are just getting their feet wet and they're understanding a new platform. Or maybe I'm testing out a new strategy I want to test out. Other than that, I go right into it and trade with a small amount. And I tell students in the beginning, you're not trading for profits. Although, if you work with me, I would say you're going to be profitable. You're really trading for the knowledge, because once you have the knowledge, nobody can take it away from you. I hear a lot of people. I live in Foster City, and it's a pretty affluent area. But I hear people here talking about, I'm going to get my check from the government. I say, create your own check. Learn to create your own check. Who cares when people say, well, how's the economy doing? Create your own economy. My economy is doing fantastic. But it's knowledge, and that's what it comes down to. So I'd say, sounds like you have a great attitude. You ran back home to get on the call. I'd love to have you on as a student. That's up to you, though. All right. Anybody else?
Yes,
I don't have a
Bruce,
question, but I just want to say hi to Eugene and Bruce.
Joe, how you doing, buddy?
Pretty
How you
good.
doing, Joe?
Very good. it's been a long time. It's been, I think last time I saw you was long time ago in high school.
40 years ago.
About
Yeah.
40 years ago. These two guys, Bruce and Eugene, they ran on the track team. And they're probably the two most dedicated track athletes that I've seen. I believe they ran the 800 meters in
And
under
you got a
2
good memory.
minutes.
You got a
That's
good
right.
memory.
You got a great meet.
Joe's
Great
being,
minutes
Joe's being
consistently?
kind though, because Joe was the state champion for wrestling. Phenomenal wrestlers. His boys, if anybody's friends with Joe, so they follow Joe, he has twin boys and another younger son, but his boys are, they're fantastic gymnasts. And I remember going over to your house when the boys were much younger. And I'm watching this kid doing cartwheels in the backflips. I'm thinking, holy smokes. But Joe's kind of like a mentor to me in a lot of sense as a father, because we're the same age, but his kids are older. My kids I have a 10-year-old, a 10-year-old, a 4-year-old, and a 2-year-old. And my kids, my 10-year-old daughter, she's a black belt, got her black belt in Taekwondo at 9 years old. And but I pushed her. She trains with Master Herb Perez. He was the gold medalist for 1992, the Olympic gold medalist, the only guy to beat the Koreans at that time in Taekwondo. He took the gold from them. And so all my kids train with him, but then they also go to, in San Mateo, they go to study jujitsu. So my youngest son and my youngest daughter, my 4-year-old and 2-year-old, they started martial arts at about 18 months. So that tells you something about me. I'm relentless. I don't believe there's limitations in life. I
just wanted to explain to everybody that that Bruce has been a very dedicated person since I've known him. He got an award in high school for for not missing any single school day for the whole entire. How do you do that? You know, it's like for 4 years he got that award, and he was always going to practice. He's always very even after high school. I think Eugene and Bruce got into weightlifting, and they bulked up at one point. And you know, I think Eugene was Mr. San Jose.
San Jose, yep.
In bodybuilding.
Yep.
And so whatever they got into, they would be very dedicated at it. They would pick things up. They would learn it. And then, you know, so many years later, I met Bruce and I found out he's in the stock market, and he's doing what he's done before. He's become very dedicated, picked things up very well, and has been very successful.
Thanks, brother. Appreciate that, man. Appreciate that.
I think the stock market has really helped us to, especially for you, Bruce, with your 3 children. You're always there, whatever they're doing. You're the only basically father there. You know, they don't even think you have a wife. You know, they just think that they're coming from single parent, because you're always there because you can. That's what this business really allows you to do, is to have that type of freedom and to not miss those important moments. So pretty cool.
Good stuff. I think someone else is going to ask a question. Great seeing you, Joe. And I think we have we're actually going out to look at a business, Joe and I. That's why I know he's very modest. We're looking at a potential business on Tuesday, so it's going to be good to see you.
Yeah.
But anybody else have any questions before we wrap up? I mean, feel free to go ahead.
Hello.
Yes. You're
Yes. Sorry, my dogs are barking.
No worries.
So I just had, before I ask my question, I just wanted to know, what was the IRS publication website?
It's publication 550.
550.
Publication 550. Great question.
Okay. And then I also wanted to know, with this offer that you guys are offering for the $997, you're extending it for the year, but how is that after? Is it like all ties are cut, or like, do we have communication if we have any questions that we could reach out in any way, if like during that time period that everything did not click, or we want to?
It really depends on, I mean, you can always re-up. It really depends on, and I'm making it for actually a year and a half, 18 months. But it really depends on you as a student. I mean, there's always like a handful of students that I really connect with. And it's because kind of like what Joe said, I don't go in halfway. I go in all the way. I mean, there's different things about me. I mean, like I get up at 4:03 every morning. I've been doing that for probably 15 years or more. And people say, why 4:03? And it's because I've conditioned myself. I believe that how you do anything is how you do everything. So it transfers over into different parts of your life. But I connect with students really that I don't know, have that same or similar, maybe not the same, but similar dedication, like a Stuart Walsh. I mean, phenomenal individual, a Myrna Moncrief, phenomenal individual. These are people that they just they put the time in, and that's why they see the results that they see. I think the only reason you wouldn't see results is because you don't put the time in. And you do that, you put the time into it. We're going to build a long-lasting relationship, and that's what I'm looking for. I'm not really looking for students at this point. You start off as a student, but I'm looking for someone also that can contribute to the group as well.
Okay, and to kind of piggyback off of that, how often is the meeting?
Once a week.
Once a week, okay.
Yeah, but during the week, so the meeting is during off hours, but during the week, you're part of this virtual chat, and I'm on there Monday through Friday throughout the week. So I'll post out trades that I'm looking at on the weekends, and I'll say, hey, here's the trades I'm looking at. And then during the week, I'll say, yep, something's changed. I'm not making the trade. And before I make the trade, I'll say, hey, I'm making this trade, and I'm going with that setup that we talked about over the weekend. So it's Monday through Friday. If you have a question or whatnot, you can chat in there. And if I'm not answering the question, somebody else is definitely going to answer the question. But Monday through Friday, we're live during the market hours.
Okay. All right. Thank you.
You're very welcome. Anybody else?
Yes, Bruce, this is Sir. I just wanted to find out what time during the week, because you said it's once a week, but what day, what time during the week does this happen?
Yep. So I've been doing it on Mondays at 6:00 p.m. Pacific Standard Time. I record it. So I put the recording into the private group. But it's been going on for Monday at 6:00 p.m. I might change that time. I don't know at this point though. I'm keeping it the same.
It's working.
Oh, okay. Yeah, it sounds good that it's been recorded, because my work shift is from 2 Eastern to 10 Eastern. So I might miss the live recording. So if you record it, then that sounds good. So I can go back to it and watch it afterwards.
Yep, you can definitely do
Absolutely.
that.
Absolutely.
Yep, and then like I said, during the trading week, you'll have access to a live chat, and it's very active in there. Very active. I'm posting things on a regular basis. There are sometimes I sit on my hands, like on this Friday. I don't think I made a trade yesterday. Markets are typically slower on Fridays, but that's not always the case. There's times where I'll wait for the market to slow down and I'll make a trade. But I announce that. I'll say, hey, I'm going to sit on my hands, guys. If you have any questions, let me know. But I'm always in there for sure.
Sounds good. And for me, I'm like super green. So am I supposed to download some applications and all that, like what you were showing us, to be able to get myself up to par? Yeah,
so that would be the first meeting that we would have for anybody that goes forward today. And it doesn't matter if you're new or not. I mean, I sit down and I say, hey, here's what I would probably use as a new student in the markets, because not everybody has, I can't make the assumption that everybody has a trading account set up. A lot of them don't. So for my hedge fund, I use Interactive Brokers, but I would not recommend that for someone who's new, because it really was designed. They just now recently opened up to retail traders, but before it was just for all professionals, and their customer service is just not. They expect you to know what you're doing. So what I would probably go through on that first call is helping you get your TD Ameritrade. I think is a great one. They have a great trading platform. My friend Tim Knight is the one that developed the profit charts. They used to be called profit charts, profit.net. And then he sold it to TD Ameritrade, which is now Thinkorswim. So great. And those are the charts that you saw me using today, was the Thinkorswim platform. So that's the other thing too. It makes it a lot easier for me. You can use E-Trade or whatever you want to use, but I won't be able to help you if you say, hey, Bruce, how do you do this particular trade? and I'm not familiar with the platform, I'll do my best to help you, but I'm not going to be that familiar with it, where I'm very familiar with TD Ameritrade and Thinkorswim.
Sounds good. Sounds good. Thank you.
You're welcome. Good to have you here.
I got a question, and I also wanted to say what's up, Bruce. Thanks for getting me on here. And hey, Gene, I haven't met you, but I've heard some things about you. First of all, before my question, I just want to say, me and Bruce I've known Bruce for over 4 years now, probably longer. And one thing that I learned from Bruce actually has nothing about is what he said about him getting up at 4 a.m. And he's Bruce is a winner. And so being around winners is something that, you know, when we would fly out and look at different investment opportunities and work in different cities and look in different cities for real estate. And the guy is a winner. So honestly, I know Bruce's heart, and I know that this is something that he's given back in a way. I would assume. I'm just on here. He just, you know, I kind of just got on, but like you know, I know for a fact that at the end of the day, this is something that him and Gene are doing to really give back, because the price at $9.97 is pretty interesting. So, but as far as the question is Bruce, you know, when you're trading weekly, how do you deal with, like, because I know that setting up a system is important, but if you are running other businesses or you have a full-time job, how do you deal with like that, you know, working with limited time?
Yeah, so that's why I like doing a lot of the hedging. I like doing a lot of the non-directional trades because I am busy. And also it just gives me peace of mind to do a non-directional trade. If I'm doing a directional trade and I'm jumping into that trade because I believe it's going in one direction, up or down, because I'll short the market as well. But if I believe that I'm going to do a directional trade because I want the maximum amount of profit, I don't only put a stop on it from a price point of view, I'll also put a time stop on it. So I have a system that I trade, and I stick to that system. And that's the thing about trading, is that you have to have your own system for trading and be consistent with that. So you start to understand what kind of performance can you expect out of that system. So I know with my system, when I'm getting to a trade technically, it produces in 1 to 3 days. It'll produce the result that I want. And if it doesn't, even if it hasn't hit my stop loss, I'm like, I'm done, and I walk away from it. But if your question is with regard to managing the trades for other trades, and you're doing your other businesses, and I know you're heavy into real estate, I would say learn about non-directional trades because that's going to be the best one to go ahead and give you consistent results. Maybe you won't get those explosive movements, but you really don't need them if you're consistent and you spend time in the marketplace and you continue to invest into the marketplace. If you're getting 6%, 7%, 8% a month, which is really not that difficult to do with a hedged position, that's what I'd probably lead you towards.
Thank you. Yeah, because I think at the end of the day, it's about being able to just pull cash out of the market and have cash. You know,
well, that's why I like.
Money.
I don't put my money into banks. I have very little in banks. I use my brokerage firms for a lot of my different transactions. Why? Because if I want to buy something, I've been in the markets long enough where I can, it's like a sales guy that knows your close rate. They know for every 10 guys you sit down with, you're going to close whatever, 4 of them, 5 of them, 6 of them. That's how I am that's why I keep a journal, because with my journal, I've learned about what my expectancy ratio is. And I know how many trades are winners, how many are losers. So, when I want to go out and buy something, or people talk about the car that I have, the Jag, they say, hey, that's a nice car. Profits from trade in the marketplace. But when I want to buy something, I'm not using my cash. I have to earn it in the marketplace. But that comes down with being in the market, having knowledge, knowing what type of strategies are going to produce what type of results, how much money are you willing to risk on any particular trade. All those things matter. But it's like I said before, and this, Corey, I do real estate as well. I like real estate. Matter of fact, I just started up a partnership doing a ground leases with the team. So it's another niche market in real estate investing that I'm doing. But anything that makes money, I like. But I particularly like the stock market. I think everybody should at least learn how to manage their portfolio.
Thank you.
You got it. Anybody else, guys, before we go? Let's see here. Anybody in the chat? What's the Julia says, what's the price again? It's $997, Julia. I know Julia does real estate as well.
Mm.
Mhm. All right. Anybody else? Going once, going twice, going 3 times. Well, guys, pleasure. I know a lot of you guys are from the Clubhouse, and you've heard me speak at Clubhouse, and I haven't done that for a while only because I've been busy with other projects, real estate projects, go figure. But I'm going to go ahead and get back into to having sessions on Clubhouse as well. But if you're serious about the marketplace, you want some help, like Corey said, $997, it's interesting. So love to have you guys join. All right. This is Bruce Dinger with brucedinger.com. My saying is, may all your trades be green. Thanks, guys. Appreciate
All
you
right,
spending
thank you,
time with
Bruce.
us on Saturday.
Thank you, Bruce.
Thanks,
right,
Take care,
Bruce.
guys.
Thanks,
Take care.
Bruce.
Pleasure.
Bye-bye.
Bye, guys.